Let's welcome in exclusively Jeffrey Gundlach. He's the CEO and CIO and founder of DoubleLine Capital. Jeffrey, welcome back. It's good to have you as always.
Yeah, good to be back on Fed Day, Scott.
Yep. Your reaction to what you just heard?
Well, you kind of stole it a little bit. I said, usually in these post-Fed press conference appearances, I have a kind of a word of the press conference, and the word of this press conference is could. He said it several times, we could cut rates in September. So he also reiterated a number of times that they have a long amount of ammunition, a large amount of ammunition, if the economy does start to weaken. But what is interesting about, I think, the messaging from Jay Powell is he said that conditions in the labor market and in the economy broadly are sort of like they were pre-pandemic, on the doorstep of the pandemic. And yet the Fed funds rate is 525 basis points higher than that. Okay, I'll acknowledge the inflation rate is probably about 1% higher than it was prior to the pandemic, but that kind of means that there's a lot of room for them to cut short-term interest rates. Our inflation model suggests that based upon where the commodity prices are and what we expect from shelter to happen, that we could get a two-handle on the CPI. We already have it on the PCE, but we could have a two-handle. We could settle in even in the low twos. And if you have a positive real interest rate that's even 1.5%, that would suggest you have 150 basis points of room to cut rates without even thinking that you're being excessive about it. So I really think that we should expect to see the markets enjoy what the Fed said here, because they said not only could we cut rates at the very next meeting, but we could cut them a lot if we need to. And I think that's very heartening, particularly for the stocks that kind of got beat up, the high beta stuff, where interest rates cuts would probably be awfully helpful.
He mentioned numerous times, in fact, to your point, that the Fed is still restrictive. Should they have cut today?
I think they should have cut today, quite frankly. But, what difference does it make? 6 or 8 weeks or whatever it is, 7 weeks. I think the one thing that I find was funny when people asked about the political climate and saying, they don't want to be political, and September 18th is less than 2 months away from the election. I just think that's so laughable that if you cut rates 25 basis points, that would have any impact on presidential politics. I think if you ask the average American what the Fed funds rate is, they wouldn't even know that it's a number. They wouldn't even know what it means, let alone to know that it's at 5 3/8 today. So I just don't really think that that's very relevant. But I think this is a pretty reassuring press conference for the markets. I thought Jay was very well prepared. He even seemed over-prepared. I thought he was reading more of his remarks, and particularly in the answers to questions, he seemed to go to a script. But that's okay. He had a thread the needle, I guess he really had to do, because it's clear that the employment data is getting worse. That's pretty obvious. I mean, the quits rate is going way down. The unemployment rate is now 7/10 off its lows. It's being artificially suppressed by government hiring, which has been in an interesting uptrend over the past 18 months or so. So I think it's clearly weakening. We see continuing claims on the rise. Initial claims are in an uptrend. So I think he wants to reassure people that he's watching these things. He's hopeful that the unemployment rate doesn't go up by 2/10 or 3/10 one of these months, but it has been rising. So we do have 2 more employment reports before the next Fed meeting, and we have 2 more CPI reports. So I think those are going to very strongly inform the rhetoric that we get and whether or not we get a cut of 25 basis points. He seemed pretty clear that they're not really considering at all, based upon the mix of the economy and inflation right now, cutting rates 50. I think that would be, you'd have to see the unemployment rate go up to probably 4.3, 4.4, maybe even 4.5 over the next 2 months, which seems unlikely for them to consider a 50 basis point cut in September. But there's cuts coming. The yield curve has been de-inverting. We're hanging out at about, 15 to 20, depends what minute you look at it, basis points, higher yield on the 2-year than the 10-year. That was out at almost 110 basis points several months ago. So it's been a big narrowing, but it's still inverted. And we still believe that there's a very safe place to be is in the 2-year, the 3-year, the 5-year Treasury, which should have pretty big rallies when the Fed, should they even cut one time, I think we'll start, we de-invert the curve and head to a steeper yield curve. The long end of the curve, I feel, is still in the throes of angst or these interest rates and the level of the debt and the level of the deficit. I know I talk about this all the time, but it's extremely important in our world today. And I think the yield curve will steepen quite a lot in the next recession.
I have to say, you sound to me rather sanguine about where the Fed is today, maybe more so than you've been since they started this whole thing more than 18 months, almost 2 years ago.
I am pretty sanguine because I think things have shaped up pretty nicely. And I think that Jay Powell is aware, and I'm going to harken back to that. He says he's got a lot of room to do things in terms of the Fed funds rate going down. And that does make me more sanguine. I think the inverted yield curve is a problem. I think these high interest rates, high short-term interest rates, and high credit card rates, I think this is a problem. And we see that the bottom end of the economy, say the bottom 40% of the population, they are really hurting on these price levels. And one way that we can monitor that is the usage of free food, food lines or whatever you want to call it, has really gone up a lot over the past 18 months or so. In some regions, it's tripled. So everybody out there that has the wherewithal, I've encouraged people to give to these types of public services. The government can't do it all. I think it's much more effective if it's done on the private level. So donate to these public services.
We still have Jeffrey Gundlach, obviously, with us. And Jeffrey, I hope you'll oblige us here. Steve has what I think is a good question for you as you talk about the yield curve still being inverted. Steve, you want to ask Jeffrey what I know is on your mind?
Well, the reason why it's on my mind, because I just talked about this idea, Jeff, which I'm sure is on your mind, this idea of steady rate cuts on the short end. Jeff, how does the curve, or does the curve, disinvert in that process?
Well, I think short rates fall. 2-year Treasury rates fall, 3-year Treasury rates fall, 5-year Treasury rates fall. And the further you go out the curve, the less they're going to fall. I thought Steve's question to Jay was really good. It actually jogged my thinking about how much room he has to cut, because Steve asked, is it one cut or is it a normalization process? And I don't know if Jay kept that question in his mind as he continued after Steve's question, but he seemed to, if I try to read the tea leaves, it seems to me that Jay Powell's answer was normalizing. I think he knows that the path of inflation is likely lower in the near term. One thing that he did speak to was the seasonality of inflation, and I think that's a bigger point than most people appreciate. The first quarter, even though these numbers are seasonally adjusted, and Jay pointed that out, even though they're seasonally adjusted, there's this bizarre pattern that is quite strongly in place for multiple years, that the first quarter comes out hot, and then the second half of the year comes out cool. And so we have a couple of PCE headline numbers, not the one coming up, but the two after that. The ones that are rolling off are 0.4. It seems unlikely to me that you're going to get 0.4 replacing them. So we still have downward momentum likely on that headline inflation, and it's further supported by the uncanny seasonals that seem to be in place, that the fourth quarter inflation is less than the first quarter, and certainly the second half is less than the first half. So these are further things that support the notion of cutting interest rates. Jay's right to say we don't know what the data is going to be. Just like I loved his answer when he said, I don't know who's going to win the election. It would be ridiculous to try to factor one party's policies versus another. You don't even know who's going to win. But I do think that these things, the seasonality of inflation is important and will be further supportive of the Fed cutting rates. I expect the Fed is going to cut rates in line with what the market is predicting. And if I had to take an under and over, I would think the Fed's going to cut rates more than the market thinks over the next. I think we have 150 basis points of cuts coming, but certainly by a year from now. It's interesting that the Fed hasn't touched the Fed funds rate over the past year, and markets since the last Fed meeting are virtually unchanged. There's almost no changes anywhere. So the market seems to have settled in and is waiting for the cutting cycle to begin, and I think they're going to get rewarded with that.
Interesting. Steve Leisman, thank you, as always, of course, for
Pleasure,
joining
Scott.
us after leaving the room with the Fed chair. So, Jeffrey, you've been pretty explicit as well in calling for a recession. Every time we've been speaking and having these conversations, the Fed chair today, as you alluded to earlier, said he thinks we're well positioned. He likes where we are. The chances of a hard landing, he said, quote, I think they're low. Has your own view changed?
No, I have the same view. I think when we look back at what today, and it'll be history when we look back at it a couple of years from now, I kind of believe that we will say that we were in a recession in September of 2024.
Interesting. Because, I mean, he still thinks that the economy, obviously, is doing pretty well. Yes, there are some spots of weakness, said the Fed chair, but overall is good. You take issue with that, too, based on what you've been hearing from CEOs about the consumer?
I think it has to do with a lot of anecdotal evidence and a lot of the, if you just don't look at one data point, like the establishment unemployment rate survey, there's a lot of things around that are not nearly as encouraging. I talked about the quits rate is way down. Even leisure and hospitality, the unemployment rate is rising. Unemployment claims are rising. The full-time employment is being supplemented by part-time employment. Some people are working a full-time job and a part-time job. They're counted as two jobs, but that's just one person who's trying to keep up, keep their head above the inflation waters. So I don't know. I just feel that I hear a lot of people anecdotally that talk about, I lost my job, I can't find a new one. One guy, I know they're just anecdotes, but I was working in the same industry for 10 years, and my company had to close down. I lost my job, and I'm applying every week, sometimes 2 jobs a week, and nobody hires me. I can't get a job. That's starting to happen. So, employment is a lagging indicator. Everybody knows that, but the trend in employment has already changed for the worse. So, and it's masked, I'll say it one more time, the government hiring is a little bit curious. If you want to make your data better, you can manipulate it by having your area of the economy do some extra hiring. And that appears to be what's happening. Government employment was on a downtrend, flattened out, and now it's been rising. Well, so I don't think the economy is that strong, Scott.
This is why you have the questions that are out there suggesting by the time that the Fed actually does cut rates, is it going to be too late? Are you suggestive that it'll be too late by the time they actually act because of the anecdotal evidence and maybe some other data that's been out that you're seeing?
Yeah, that's exactly what I think, because I've been at this game for over 40 years, and it seems to happen every single time. Because employment is what's holding them up from cutting rates. Real rates are really high. You've got the PCE down at 2.526. You got the Fed funds rate almost 300 basis points higher than that. So that's pretty restrictive. And unemployment is trending higher, and all of the other underlying aspects of employment data are not improving. They're deteriorating. And so once it starts to get to that uh-oh level where they have to start cutting rates, it's going to be more than they think. And I think we're going to see about 150 basis points of cuts. That's my base case over the next year at the most.
Well, I mean, that's, I guess, obviously why you still think that treasuries on the short end are still a good value here, because presumably rates in subsequent months would continue to move lower. So you haven't missed your best opportunity yet.
Yeah, I mean, if rates are lower, I mean, when the CPI came out, it changed inflation expectations. People were surprised by the weak CPI number, and all of a sudden, the expectations for inflation out 6 to 9 months have come down by about 50 basis points. But one thing that might be worth thinking about in portfolios is the Fed is going to start cutting rates. I love the analogy. I think it was Tyler who said it. It looks like they have the tee out, and now they've put the ball on the tee, and they're going to whack it. You know, first they weren't even carrying a tee. Then they put the tee in the ground. Now the ball's on the tee, and they're going to start cutting rates. That means that the best trade of all for the past couple, 3 years, which is floating rate assets, floating rate, higher quality bank loans, which I've been recommending for meeting after meeting, you might want to start. You don't have to do it tomorrow, but you might start gradualistically shifting into fixed rate securities. So if you have BB bank loan types of things, which have performed extraordinarily well, maybe it's time to rotate into BB fixed rate high yield bonds, which I think are very safe. The high yield bond market is tight on spread, and the economy is weakening, but the quality of the BB high yield market is pretty good relative to historical standards. And so I wouldn't be afraid of owning the BB high yield market, and yields of around 8% are not easily obtainable, but can be found in a low risk manner. So we've actually started in the funds where we do this type of thing, started to make those types of movements just very recently. In fact, this week.
Interesting.
Moving from floating rate into fixed rate.
Oh, I know our viewers appreciate the actionable advice from you. Speaking of gold, you've liked up $40, was at session highs as we were hearing the commentary from the Fed chair and certainly parsing the statement. Do you still like gold?
I do. Gold seems to be kind of in a world of its own. I think it has a lot to do with geopolitical problems globally, which just seem to be getting worse. Just think of what's happened in the last 3-4 weeks, Scott. Just think, it's almost hard to believe that it's the same month, as July 1st, because we've had an assassination attempt. We've got bombings going on with Israel, Iran, and their neighbors to the north. So don't forget about Ukraine, which hasn't gone away. And of course, we have this presidential election nonsense going on, where switching out candidates. This is a very, very dangerous geopolitical time. If you were thinking about making a move that you would hope that the United States would not counter, this seems to be the time to do it.
You remain concerned, I know, speaking of politics, about the deficit. You published a new paper this morning, as a matter of fact, on the federal debt and deficit spirals is how you're terming all of this. So what do you think happens then in the months ahead? Obviously unknown as to who's going to win the election. One of the candidates, the former president, wants to re-up the tax cuts that are going to expire. You told me the last time we were sitting in your office there in Los Angeles, you think that would be a bad idea. Obviously, the Democrats have certainly stimulated the economy, to say the least, with their own spending plan. So how do you shape it all up now?
Well, this deficit problem is what's fueling is a problem in that we can't afford the interest expense, and it just keeps getting worse. And the Fed, being higher for longer, keeps these rollovers of bonds that are maturing, and there's a lot of them. They're refinancing them up 300, 400, 500 basis points in some cases from where they were. So we have the interest expense as a percentage of tax receipts is at a completely unsustainable level, and the trajectory makes it very unsustainable. We're headed to a place where we're going to have a substantial fraction of tax receipts under our current structure go to interest expense, and it's getting to the point where you can't ignore it anymore. The interest expense is higher than the official defense budget, and it's rising in a vertical manner. This has to be addressed. So how do you address it? Well, you can alter the entitlements. I know that's not going to happen with whoever gets elected here, but we have to talk about that, at least at the midterms after the presidential election, because we can't afford this huge amount of retirees that are expecting and receiving these benefits, whether they need them or not. That isn't going to solve the problem exactly, because the unfunded liabilities are so big. But we're going to have to come up with some very unconventional solutions to this. And this is what makes the investment business and our political system structure so fascinating for the next 4, 5, 6, 7 years, is that it's in that time frame that we must address these problems. Otherwise, interest rates on 30-year treasuries will start going up in spite of recession. That's what's worrying me here. If the recession comes, the deficit goes up. it goes up even more. And the response, as we saw certainly in 2020, 2021, is more government spending and more government money printing, which would lead to a high degree of fear, deservedly, that we would have a repeat of the inflation spike of 2022. We now know that modern monetary theory has been completely debunked. They said you could print money and it wouldn't matter, inflation wouldn't go up. Well, that didn't really work very well. We're still talking about inflation being too high 3 years later. And so that response would be devastating to the long end of the bond market. So we'll see if they start going there. You might see a metaphor to what happened in the UK, where they had some bad fiscal policies, and the interest rates on the long end went up like 100 basis points in a very compressed time frame. It may have even been in a day. That's the risk that we have if we don't get these policies back on track. And that means having a government that isn't pumping out this type of a deficit. But if that's the case, the change in deficit spending decreasing would be a direct hit on GDP. So it's a really interesting conundrum. And I hope that we have the right character, the right personality, the right brain power to help figure this thing all out, because it's coming at us now. It's not our grandchildren's problem. It's our problem.
On that note, my final question to you is, who are you supporting in November?
No, I don't support anybody. I've never been so foolish as to say I support somebody. I don't donate to political parties. I haven't in forever. But I do think that the Electoral College looks pretty strong for Trump as of July 31st, 2024. But the way these things are moving, the way events are, it's like, I think it was one of these Soviets, I think it was Lenin or Stalin. He said there are years in which nothing happens, or even decades in which nothing happens, and then there's weeks in which everything changes. And it seems like we're in one of those compressed time frames of change. So, stay buckled up. But at least the Fed seemed to be on top of their job, and they're saying things, maybe in code, but they're saying things that I think are suggest that they're thinking about the right things.
Okay, we'll leave it there for now. I so much appreciate you joining me. And in September, we could be talking about the first rate cut in this cycle, Jeffrey, and we'll be doing it from your office at DoubleLine. I look forward to that as well. We'll see you then.
Right, and when you come to the office, Scott, you're going to have to stop by the Buffalo AKG Art Museum. We have a show up by an artist that most people don't know, but it's in the 1960s and 70s was an absolute superstar. Her name is Marisol, and she created these sculptures that are really interesting. A lot of times people go to an art exhibit and they want to go see Van Gogh, and they go there and they see all the Van Goghs that they already know exist. Most people don't know how great Marisol's artwork is. And this show, I think it was One Art magazine said, this is the art highlight of the globally of the entire summer of 2024, and it's up until January. So I'd like to take you there, Scott, if you can spare the time.
I'll see if they'll give me a couple of days off. We'll discuss offline. Jeffrey, thank you. I'll see you in September.
All right. Good luck out there, everybody. Thanks, Judge.
All right. That's Jeffrey Gundlach joining us from DoubleLine, as always, on this Fed Day.